And today we are going to be talking about futures, building your trading edge from the ground up. We're having a re-look or a look in the rearview mirror at how to get involved in trading futures. And to do that, I've invited Ryan Gorman from the CME Group over in Chicago, and he's brought along Jim Iorio, who's the Managing Director at TJM Institutional Services. Welcome, gentlemen. How are you both?
Very good, thank you.
Doing awesome. Thank you so much.
Ryan, why don't you tell us about this series that we're launching today, and give us a bit of Jim's background too.
Of course. Yeah, first of all, everybody that's in here, thank you so much for coming. Jim and I are super excited to get this series going. So essentially, we wanted to come up with a program that's going to kind of take people through, beginning to end of futures trading, where it starts and where it can lead you to, and then kind of finalize it by bringing everything together. So this is going to be part one of a 5-part series. That series is called The Futures Long Game. And we're going to get into a little bit today, a lot of, welcome to futures. What are some things you can expect? But it's building your trading edge from the ground up. So basically the futures foundation. And, I'm really happy to have Jim Iorio on here. Me and Jim have done a couple different things together. I really like his perspective. Jim's been trading in these futures markets for a very long time, has a deep knowledge across many asset classes, and can bring a level of expertise and, that veteran feeling for these futures markets. So Jim, if you want to give a brief rundown of kind of your path before we get going.
Sure. So I started at the CME with Goldman Sachs 38 short years ago. That's why there's gray in my hair and I wear the glasses at the end of my nose. It's been a long road. And I've been just fascinated by these markets ever since. My clients are big institutional clients, but I also trade my own capital, and I have for many, many years. I've always loved futures, and I know we're going to get into this part of it, but futures' greatest asset is also its biggest flaw as well, and that's that it's an extremely powerful instrument because of the leverage they allow you to use. Now, if you know what you're doing, it's a great thing. I always liken it to the power tool in your garage. If you know exactly how to use it, the barn gets built quickly. If you don't, somebody's going to lose a thumb. And I'll stick with that because it's true. So I do these things because I don't want people to make some of the same mistakes that I've made, because futures can be dangerous, but they can also be very, very lucrative.
Awesome. Yeah, I mean, you set us up perfectly there, talking about, how futures can be really great and that have that downside risk as well. But we're going to kind of jump into things here. What we're going to start with, before we get into it, a brief disclosure, none of this is specific trading advice. We are going to look at a couple different charts from, historical products. We're going to talk about different trading ideas, but this is all, for educational purposes. Hopefully from here, this will be your stepping stone to start doing your own research, learning a little bit, diving into the education about futures markets.
And can I just interject and go through a little bit of my housekeeping, and then we'll move right along. As Ryan says, there's a disclosure on the screen there. Please take a moment to read that. IB compliance always asks me to put up these disclosures as we're talking about riskier assets and so on. Today is a live session. Please do use the chat panel to answer any questions for Jim and Ryan as we go in, and then we'll do a Q&A either throughout or at the end of the session, but we'll certainly get to those questions. The handouts for today's session are in that handout section. Just click on that little white triangle, expand that area, click on the PDF link to download the PDF to your desktop, and you can access it anytime. You'll also receive a link to the recording a couple of hours after we've wrapped up here with Jim and Ryan today, and you'll be able to access the recording from the Interactive Brokers Campus website under the previously recorded webinars. With that said, I'm going to go on mute, and I'm going to interject when I hear something fun. I'll tell you what, Jim, 1987, you must have started in these markets then.
What's that, Andrew?
I say you must have started in these markets in 1987.
1987 is correct. I got out of school in June and started in July at with Goldman on the floor.
Yeah, and look what you did by October. Huh.
Oh, I love telling that story too. That was like my best day and worst day ever in my career, was when the stock market fell apart. I knew I was terrified, but I knew I didn't want to be anywhere else. So that's an interesting point you bring up. Yeah.
Excellent. Okay, I'm going to go on mute. Please crack on.
Awesome. Yeah, again, like I said, everybody, thanks so much for joining. Super excited to kind of kick things off here. So as we kind of go through these slides, I'm just going to be throwing stuff at you, Jim. You know, a lot of it's going to be a little bit more fundamentals, but I'd love to hear your input. So, you know, let's have some fun with this. Let's see where we can go. But yeah, again, the title of this whole webinar series that we came up with here is The Future's Long Game. Trade smarter, trade longer, grow stronger. So we want to build people, you know, that general foundation of, hey, where do I start? Now where do I go? Now that I have these skills, how can I apply them? And then how can I bring everything together? Looking at futures, and then eventually we will get into, you know, options on futures, spread trading, technical and fundamental analysis, risk management, everything. So super excited to get things going here. So as we kind of continue, again, you know, me and Jim will be going through all of this. But today, you know, what we're going to do, we're going to dive into like an intro of the futures world. So explaining what futures are, how they work, different kind of markets you can trade. We're going to talk about responsible trading, risk management, position sizing, capital utilization using futures, some of the differences between, you know, just basic equity trading, basic stock trading relative to looking at our futures products. And then we'll kind of finish it off by looking at different charts and, you know, different things like that with margin. But as we kind of get into it, you know, futures contracts, you know, what are they? So futures contracts, you know, they're not assets. They don't represent ownership. Futures contracts are tools that traders can use. But more importantly, what are they not? So futures contracts, they are not assets. They don't convey any rights of ownership, nor do they pay or accrue interest. Futures contracts, you know, they provide certain rights and obligations. All of the mechanics of futures contracts, you know, the basic idea, you buy a futures contract on any market if you believe it's going to go up in value. And then on the other side, if you're thinking a market's going to go down, you can sell that contract. And the mechanics of buying and selling futures contracts is a little bit different. And we will get into the margin a little bit, you know, as we kind of progress here. But, you know, generally speaking, futures contracts, kind of the big takeaway just right off the bat is, you know, I think everyone can understand the basic idea of a stock. You know, if you buy a share of a stock, you are a part owner. You are buying ownership in the value of that company. When you're looking at futures, these are standardized contracts that don't have any sort of ownership. What they are is a tool for you to speculate on a product, or a tool for someone to go in and hedge on a product they're looking to buy or sell in the future. So some of the key differences we will walk through, but, you know, just right off the bat, you know, describing exactly what these things are, you know, will get you in the right mindset, you know, thinking about, you know, what they are relative to equities.
Can I add something to that real quick, Ryan?
Yeah, go right ahead.
So one of the beauty of that, having a futures contract being like, let's call it a 2-month out is when it expires and when you have to satisfy the contract that you entered into or with someone else. Now, the beauty of it is that it makes easier for two-way long and short trading. Now, I've had things happen to me trading equities before where I go to short something and I couldn't borrow it within my brokerage house, so I couldn't short it because it's an actual asset that you're shorting, so you have to borrow to short it. With a futures contract, that does not exist. And that's probably why futures contracts kind of matured from the beginning, to make it easier to, well, from the agriculture standpoint, for delivery of grains in the future, and people can speculate on the prices then, but that's kind of morphed into the beauty of being able to short it without owning it.
And that's a great segue into kind of what we're talking about here on this slide. You know, being able to buy and sell a contract in the same way is what really is a big separator between futures and equities. But, you know, because futures contracts are not an asset, they don't require payment of notional value for the contract. So what futures contracts, you know, how they work is in initial and maintenance margin. So basically, when you think about securities, about margin, so basically securities margin involves borrowing capital from your broker to buy shares of a stock. And this loan from the broker, like you said, you know, you didn't have enough in your account to cover it. It could be up to 50% of the stock purchase. Margin on futures, you know, sometimes it's referred to as a performance bond, but each product will have a specific dollar amount that the initial margin is for a contract. I believe, you know, if you look at like the micro S&P contract right now, it's around $3,000. So if you wanted to jump in and buy or sell a micro S&P contract, your account balance would have to be greater than that initial margin number. As long as that is a fact, you are able to establish a long or short position in any of our futures products. So that is kind of that key difference there. And then the maintenance margin kind of brings it where that's just the amount that you need to maintain in your account in order to hold that position.
Can I interject something real quick, because you said something wrong? The micro S&P contract would be 30,000, not 3,000. $5 times the index, correct? Would be S&P's be? So that'd be 30,000.
For notional value, yes. I'm just talking about initial margin.
Totally apologize. Sorry, back on track. We'll edit that part out when it goes live. Oh, we're live already? Oh, forget it.
No, it's good. I need somebody checking me just in case I do. Okay, that'd be a huge error. No, but yeah, thinking about just initial margin, and that number changes very, very often. It's one of those things when you get into futures, you know, understanding what the initial and maintenance margin is going to be critical. You know, just understanding how much capital you need to put up for a position, understanding how much capital that's going to leave you to look at other markets that you might be interested in, all this different stuff. So it is one of the kind of foundations that you'll need to understand, and the difference, because you know, you might look at a futures price, you know, looking at the NASDAQ being, you know, near 25,000, you know, if you think of that in stock terms, you would just think, oh, if I want to buy a share, it'll cost me this much. But on the futures side, that margin is going to be different for each product, for each asset class. So understanding that, understanding in times of volatility, that will change. Heightened volatility could bring higher margins. It could change things dramatically. So keeping that in mind is going to be important as you start looking at different contracts.
Love it.
So this is, you know, it's a little rough to see, I understand that, but I think it's important to understand just all the products that are offered for futures. And, you know, right now we would consider having 7 asset classes, adding cryptocurrencies to that list here. But for now, you know, it is included elsewhere. But thinking about all the different products that CME's offered. I mean, the CME, you know, way back in the day, the CME butter and egg board, you know, where the CME started was agriculture products. It was, you know, it evolved into soybeans, corn, you know, even cattle products. And, you know, that's where kind of the agriculture markets began. That's where really a lot of the futures markets began here in Chicago, was, you know, a lot of hedging and speculating on these products. We've seen tons of evolutions looking through energy markets, looking through foreign currencies, interest rates, precious metals, and then equities, and most recently the crypto markets that are constantly evolving. But within each of these asset classes, there's tons of different products you can look at, which gives a lot of different opportunity. Like we mentioned with agriculture, you have your corn, your soybeans, your wheat, your cattle products. Moving to energy, you have crude oil. You know, the equity, you know, some of the big names in the equity markets, you have like the S&P, the NASDAQ, the Russell, you know, which is, all these markets have been real hot lately and a lot of attention going there. FX, you know, with how the dollar is relative to a lot of these different currencies all over the world. In the bond market, and then of course the precious metals, which the precious metals, I know that's on everybody's mind, looking at silver, you know, north of 50 today, you know, gold at all-time highs again today. So, you know, when you're thinking about futures markets, you know, a lot of the times, you know, some of the initial feedback I get is, you know, for someone that might not have looked at it is, well, I don't really, you know, I don't need to trade oil. I don't need to trade corn. You know, I don't want, you know, the horror story. I don't want to, you know, barrels of crude oil showing up in my lawn. So I don't understand the mechanics and I'm going to avoid it. There's a full suite of this different asset classes that you can get access to. And, you know, you can establish biases in these markets across the board. So there's a lot of these different markets. Jim, when you're kind of looking at this, you know, talk about kind of how you look at these different asset classes. You know, have you traded all these asset classes, and, you know, what does that mean to you?
My guess is I've traded every one of those asset classes at some point in time in my career. But I'm going to tell a quick story that shows why. Because on our show, The Futures Edge, with me and Bobby Icino, one of the things he always says is that if you want to be long crude, don't be long crude. Because a lot of times people in equity markets will say, well, the names of the big integrated oil companies correlate well to crude, so just be long them. I will tell you a story about what happened to me probably about a month ago, is that I've been a copper bull for 6 years, okay? So I have been putting on positions in copper, and one way I was putting them on was through one of the biggest copper miners in the equity space, Freeport McMoran. Those, I'm not, again, my licensing is for futures. This is not a recommendation, but anyway, so I had that position on for years. It was doing great. It was correlating with copper. So about a month ago, I look up, copper's up 15%. I'm thinking, great, I'm in the chips. This is going to be fantastic. So I go on to my my equity account, and I realized that copper's up 15% because of a problem with a mine. Well, guess who owned that mine? Freeport-McMoRan. So Freeport-McMoRan stock was down the 15% when copper was up 15%. So the point I'm trying to make is that if you have an opinion on a specific commodity, it's probably best to just trade that commodity and not a synthetic sort of version of it. So that's what going in the futures, you'll be using the copper and the micro copper. And if I have to roll those contracts every 3 months, so be it. I'll roll them every 3 months. Although there is liquidity in some of the deferred months. So you really, if it's a long-term position, you don't have to be rolling it every 3 months.
That's a great point. And one thing I heard a long time ago is, I'd rather trade futures than trade a derivative. I'd rather trade a derivative than a derivative of a derivative. Bingo. And, if you think about it, a lot of these markets, if you really dive into the math, you'll get a little bit of tracking error. So, if you're looking at these hard commodities, futures are a great place to look. So I really just wanted to highlight, all these different products, and this doesn't even scratch the surface, really, with what CME offers in the futures markets. It's just sort of the most traded products in a lot of these different asset classes.
Right, and there's something we haven't mentioned yet is that they trade almost 24 hours. They trade 23 hours a day, and liquidity usually is pretty good at any of those hours. So there's oftentimes something will happen in the equity world that I want to hedge or take profit from before 8:30 equity open, and I'll have to do it get to do it in the futures market to establish my position. You went on mute, Ryan. I can't hear you anymore.
I think we lost you, Jim.
You lost me?
Oh, I can hear you now. Okay, we're all good.
Okay,
I thought I cut you out on sound. No, but yeah, what we're going to get into, there's a great table. It kind of talks about futures versus equities. That 24 hours is going to be, a huge highlight. So we're going to get into that too. But it's a really good point. I mean, overnight volumes too. We see, a lot of the times, some of the biggest events we've seen over the last decade, a lot of that volatility is overnight. And if you're holding equities, you just kind of have to sit there with your hands up and hope for the best.
Yes, these are global markets, and global headlines affect global markets, and everyone is not constrained to our 8:30 to 3 o'clock equity open.
Yeah, of course, yes. And then as we kind of think about this, it's a global industry, and there's tons of different, companies, people that use our products. So the next slide, just shows a little bit of a representation of exactly, the different types of industries that are using these products. So when you step away, if you think about, a farmer or a rancher, they would have a hard time sleeping at night or conducting any business knowing, hey, I have to sell corn next year, I have to sell beans, or I have to buy corn or buy beans next year, and I have no control over where the price is going to be, and I have no way to protect. That would be a big problem. Having these people be able to step in, create price floors or price ceilings for the product that they plan on buying or selling is super, super important. If you think about like an airliner, who's going to be buying, 1 million gallons of jet fuel, they need to be able to protect themselves over the volatility in crude oil markets. If that price is going to skyrocket, if it's going to come down a ton, they want to be able to protect themselves. And an important reason I often like to emphasize is, when you think about it from the business standpoint, if you can go to bed knowing, hey, if you're the CEO of a big airliner and hey, I'm protected regardless of this global market, think about it if you were not. If you were not protected, it would be tough for you to continue to grow the business, continue to hire, continue to expand that business. Having these protections, it can have a sense of security where hey, I can continue to grow my business. And it allows for innovation, it allows for expansion, all these different things. So it really ties everything together, and it gives these companies, these businesses, the ability to continue to have growth, because they know that even if crude falls out of the floor, goes way up, they have the ability to manage that risk.
No doubt about it. I always view it as it's like just an insurance policy for farmers, because farmers are growers. They're interested in what they do to get corn out of the ground. They are not corn traders, so they pay somebody else to take some of that risk. It's just like an insurance contract. And by the way, that's why I've had some frustrations of presidents over the last decades who, as soon as there's a problem in within the farming world, they throw money at it and give money to farmers, which is, I'm not even bashing that part of it. What I'm saying is that these markets exist to sell, well, they started to sell insurance money to these farmers. I wish they would just be more actively hedging as part of their business strategy instead of relying on government handouts. But I'm not saying relying on. I said that wrong. But it's just there's a system in place is all I meant. Can I tell a quick story about failing to hedge by a big company? Because this is one of the reasons I got involved in futures. Is my father worked for United Airlines. He was the head of the payroll department, and it was back in the 70s or even maybe early 80s. They were opening up lines into Tokyo and throughout Japan, and there was this big thing in the Tribune about how they failed to hedge their currency risk, and it ended up costing them a ton of money. And I remember even thinking at the time, I was probably 15, is that there's got to be a better way. And I'm not saying there was any sort of early savant in the futures world, but that it always stuck with me, is that a major institution would fail to understand where the risks are. And that's, I think, one of the many things that funneled me to the futures world. Also, the people I knew who were in the futures world were making more money than accountants at United Airlines, and that was probably the second reason, right?
Yeah. Yeah, I mean, that is an interesting story. I mean, just thinking about how big some of these firms can be and, where their attention goes. So having that protection, it's just critical, not having to just sit back and hope for the best. So I think this slide's super important just to highlight that, how global this industry is and how it's all affected.
No doubt. Yeah.
All right. So kind of as we continue, Jim, this is one of the slides I mentioned that just gives a decent representation of futures contracts versus equities. I know you are on the road a lot talking with different traders on the retail side. I am as well. And, I wish I just had this printed and I can give this to people. But it's something I talk about all the time, which I trade stocks, How can I use futures? Should I look at futures? What are the differences even? Things like that. People will say, I trade USO, I trade GLD. Why would I look at gold or oil? And there's a ton of different reasons why it can be used as a, supplement to your account and additive to an equity portfolio. But some of the key differences, like I mentioned, ownership representation, that's going to be simply for equities. Trading on that exchange, although it be a different exchange, both are traded on an exchange. And then with equities, shorting is really that difference, requires a locate to short, and that can incur borrow costs. And then the price differences are going to be ticks versus, just cents, 1 cent for equities. But if we look at just futures, why are futures different? The expirations is going to be one. So the futures contracts all have a contract code with that month and the year that they are going to expire. So with an equity, you can buy and hold an equity forever. You can buy Apple and you can hold it and hold it and hold it forever. If you look at, the E-mini S&P 500, for example, if you buy the December 2025 or sell it today, there's going to become a point where you need to manage that position. You'll either have to roll it, maybe get out of the position and then reestablish one, or just cut the position whenever you like. But there is going to be an expiration for that. Inherent leverage is a big one, and that comes with the ticks and the value in a tick. A great example just right away, the E-mini S&P, again, just to keep it even here, every tick is worth 0.25, and each 0.25 is worth $12.50. And I'm a dollars thinker, so the way I think of it, every dollar move in that E-mini S&P, that's going to be $50 up or down on your position. So outside of that 24-hour access is going to be that last big punch, nearly 24-hour access. It's more so like 23.5, but how many times, if you're an equity trader, are you up at 7 a.m. looking at your portfolio? How many times are you watching your portfolio during an earnings report for, a big tech company that's going to affect the NASDAQ, or any company that you're looking at? Futures, not saying you have to jump in and be trading at midnight, but you have the ability to at least manage risk. You have the option to go in, establish a bias at hours that you might not be able to on the equity side. If you want to do some sort of hedging against a position in your equity portfolio, you have that ability. So, there's a lot of different, ways that futures and equities are the same, but some of the differences really, really are very different. And it opens up a whole new world to a lot of traders that might not have known about it in the first place.
Yep, and I'll comment on that too, because the leverage part of it, I think, is probably the biggest advantage of futures as far as efficiency of capital, provided you know how to use it. I'll keep saying that too. Don't be a cowboy in this. We know old traders and we know bold traders, but we know very few old, bold traders. I say that all the time. So mitigation is the best thing. But think about now how the Mag 7 are 35 8.5% of the NASDAQ right now. And they always report their earnings after the close when the standard markets are closed. Now, you can still trade after hours in some stocks, but the liquidity vanishes pretty quickly. But the liquidity in the NASDAQ contract doesn't vanish very quickly. And that's still open when these huge companies that have outsized and disproportionate effect on the entire NASDAQ, that's what you can trade to hedge yourself or to speculate if you want to trade after the noise.
100%. Yeah, it's super important to understand that. And again, it's people always tell me like, well, I don't want to be trading in the middle of the night. I don't need to. But you forget about just 7 to 8:30 a.m. economic reports come out. 3 to 4 p.m. Here Chicago time, things are happening, and a lot of times you can see outsized market moves that you might have a bias on, and you may want to establish something. So it gives you that chance. So I always like
one last thing is that when I think of the fact that they've never changed the hours that the equity markets are open, it's 8:30 to 3 o'clock. That seems so short-sighted. And again, I'm not trying to point my finger at a different industry and say you guys screwed up, but they did. I mean, it seems like they should have opened them up different times. I don't know who was fighting against that. I picture some old Wall Street guys from the 60s going, no, we don't want to open the markets till 8:30. But anyway, that's just my 2 cents there. Yeah.
Yeah, it's one of those things that we really enjoy. But thinking about the why, so this is, I said the last slide I get a lot of questions on. I mean, this is numero uno. This is number one. Why? I trade equities, I trade options on equities. I get it, and it makes sense to me. Why should I look at futures? One is capital efficiency, and we're going to get into a real life example of capital efficiency, looking at a different market. But being able to take your dollars and apply them to establish a position in a market at a more cost-effective way. And with futures, you have that access. We mentioned around the clock trading and the advantages there. Ease of going short. With futures, having that margin requirement allows you to take a long or short position in the market of your choosing as long as you maintain that margin. Tax considerations, please don't grill me on this one. I'm not a CPA, but there is 60-40 tax treatment, for long-term and short-term gains with futures, and it's definitely important to understand when you're looking at these markets. Jim, you talked about, the pure play in a lot of these markets. The way I described it, trading a derivative of a derivative. With futures, if you want to trade oil, you can come trade the price of oil here, and you don't have to worry about, some mining company going under and, hurting the overall price on the equity side. Yep. Again, CME, like I mentioned, we were founded in the 1800s as the CME Butter and Egg Board. We've been around for 2 centuries. We have a lot of credibility. People understand that our markets have been, tested. Our markets have seen big upswings and huge downswings, and they're stable, and they're still around. So traders have the ability, whether they're just hedging for a huge company or just coming in and speculating on markets and doing scalping, they know that there's a trusted marketplace. A lot of equity traders too, they're involved in a lot of technical analysis, a lot of technical indicators. That's gonna translate right over to the futures markets. A lot of futures markets are very technical. And you'll get markets like the agricultures or, maybe the oils that typically are within a certain range of prices. And there can be a lot of really good technicals you can take from what you learned on the equity side and apply it directly to futures. And then execution and liquidity costs. But as I kind of look at this list, Jim, what kind of stands out to you, when you're thinking about it, when you're telling somebody about futures and the why, what do you go to immediately?
I flip back and forth. I know before I said that I thought capital efficiency so it's basically like a 15-to-1 ratio as far as margin in the equity indexes, somewhere on there. Don't quote me on that, but it's close to that. Whereas when you trade cash equities, it's usually 2-to-1. So that I sometimes think is the biggest deal, but then around the clock, I find myself, and again, we're not suggesting that anyone trades at midnight, but I love the fact that futures markets are open and liquid, and I have been known to get up in the middle of the night and check markets, check trades I have on. Again, when you guys get a little older, you don't always sleep that great, but I think those are the 2 biggest things. The only, actually, like these, I will actually, in the sense of fairness, say what the downside is of futures compared to cash equities is the need to roll positions to stay exposed the way you want it to. Now, that being said, most of the people we're talking to here are pretty active traders or active portfolio constructors of their own. So there's someone who's involved in the market almost every day. Then that becomes not a big deal at all because you understand what it is that you have to be on top of this. You can't set it and forget it. This is for people who are noses to the grindstone within the markets.
100%. And, I think when you think about all this, what we're going to get into next is going to be, a little bit more about margin and the margin and how that ties into capital efficiency. But I really like the way you kind of put that because, every trader is different. There's going to be different reasons why you want to look at different things. But as we kind of think about margin just right off the bat, I talked about this a lot. So we'll get through this and then we'll kind of get into, how to look at notional value. And then I'm going to get into a real example off that notional value that's going to show people looking at like the gold market, kind of how this all ties together. Because it really is, all put together is the easiest way to understand it and the most effective. But again, initial margin, if the initial margin on a contract is $3,000, as long as you have $3,000 plus in your account, still have $10,000 in your account, in your trading account, even $5,000. You can buy or sell whatever that futures contract is. And if that futures contract goes against you, then that overall product will go down. As long as your account stays above that initial margin and that maintenance margin, you can hold that position. Now, if it goes up, then you're just making money on the position and that's great, you found a winner. But understanding that you need that initial margin in your account, and anytime you go below that, you're gonna have problems. That's when position management will come in, the margin calls where, you'll either have to deposit more funds into your account in order to maintain that position, or you'll have to cut the position and reevaluate from there. So that margin, again, if you are looking at futures products, if you just go to the CME's website and go to product specifications, it'll list everything you need to know about all the products. The tick value, you can see the margin, and it changes very often. So it's important, it changes marginally very often, not huge swings up and down, but it is important to understand, especially if you want to look at multiple markets. A lot of the times, people might want to look at oil and they want to look at the NASDAQ, or they want to look at the S&P and gold. And you have to understand kind of where everything kind of lines up. So it's important to understand that, but understanding how the notional value works also is kind of the second part of this. And that's kind of the next slide we're going to get into. I understand that in this next slide, the prices are slightly different. It needs to be updated on my end with the actual price of the NASDAQ. But the NASDAQ, when I made this slide, was trading around 20,450, which now it's nowhere near that. But, or the E-mini futures here. So if we kind of look at this, notional value is determined by the multiplier. And a lot of the times when I talk to equity traders, this can kind of trip people up, because especially people that trade equity options. When you look at an equity option, if you look at it and it's worth $2.05, if you're looking at an option on the equity side, pretty much anyone that trades them automatically knows that's 205 real dollars, that's what the cost is. The multiplier for futures contracts is different for options. And there's a multiplier for the contracts in general that will get you the notional value. So if we just look at the NASDAQ, so for the NASDAQ, the E-mini NASDAQ futures, the multiplier is 20. So if you take that 20 and multiply it by the price of the NASDAQ at the time, it was 20,450, that is going to get you that $409,000. So basically, when you think about that, if at the time that this was made, if you bought one E-mini NASDAQ futures contract, you were controlling over $400,000 worth of NASDAQ exposure. That's that inherent leverage that we were talking about. You can take the initial margin, put that up, take that from your account if you have enough to establish that position, and you can get access to $400,000 worth of NASDAQ. And then just showing like a 1% move in that being significant, being over $4,000. So again, these prices are going to be slightly different once we, dive into the prices today with the NASDAQ near 25,000, but the math still checks out completely. And it's important to know that, if you're trying to figure out what size you want to be trading, if it's mini or micros, because you can see right below looking at the micro NASDAQ, that contract is 1/10 the size of the E-mini. So the multiplier being 2, that changes things dramatically. So if you're looking at that, it's a $40,000 notional value contract with a 1% move being $409. So, if you're somebody that only has, not as much capital, you don't have a 6-figure account and you're going to be looking at these micro contracts, it allows you to do a lot more. It allows you to look at different markets. It allows you scalability in a lot of different markets where you don't have to get in and out at the market's demands. You can do it at your pace and where you want to go. Jim, I want to throw this at you because I know you're a big, proponent looking at these micro contracts, being able to scale in and out. Talk to me about this and how your career has evolved around, since 2019, since we established these micros.
I think the reduced size contracts and all the different assets have been an absolute game changer for me and for everybody. Again, so like I said, I've been in these markets for 38 years. I'm not, how do I put it? 20 years ago, I was trying, to make the retirement money all the time, and I was, a bigger trader. Well, now I don't have. I'm going to trade until my mind no longer can make out the numbers on the screen because I love trading. But I don't love to take huge amounts of risk anymore because I don't need to any longer. But I like to be involved in all these markets. So the micros are excellent. And then, by the way, the micro NASDAQ, it's called the micro, but a wicked move all of a sudden, can set you back some money too. It moves, the NASDAQ moves relatively quickly, as does gold at times, Bitcoin at times. But I think these are absolute game changers. Prior to these, it was mostly an institutional setup. Like even just think of the evolving of the Bitcoin contract. When the CME first launched its first Bitcoin contract, it was 5 Bitcoin. Well, that's an enormous contract for a market that can move 20% in a day. Bitcoin's a highly volatile thing. So then they put in the micro, and now the Friday expiration Bitcoin contracts, which allow much different levels of not sophistication, but of actual depth of your pockets to be able to look at these things, test new trading strategies. Like you said, scale, where it used to be, you were in one contract and maybe that was the peak that your account would allow. Now you can have 5 of the micros and scale them off at different levels. By the way, there is something, we talk about risk mitigation quite a bit. Something similar to this has happened twice in my career. I'm going to tell the story about what happened to me on Monday. Is that okay? About the spot quoteds versus the micros.
Yep.
So I had them both up on my board, and this happened to me twice. And again, I'm someone who's been doing this for 38 years, and I only tell this story to underscore that there's risks involved. On Friday, I was messing around with the new spot quoted NASDAQ contracts, which are 1/20th the size of the micro. I was just trying to kind of test liquidity. And then when I went to cover the position, I had a handful of them. I covered it, but I covered them in the micro by accident. And I didn't, it was Friday afternoon, and I usually always check my statement before I go home to make sure everything checks out, and I did not do that. So Monday morning comes in and I'm short a handful of the micros, and the NASDAQ is up 500 ticks that day. So I just start out the day, losing 10 grand because I'm an idiot. My point being is that you check your statement every day. You got to learn. Even people who learned it and forgot it and learned it and forgot it still make mistakes sometimes. Last time I made a mistake like that was several years ago, and it turned out being the other way. So now I feel I'm even. So anyway, okay.
Yeah, no, it's a valuable, story to tell. I mean, for people just, really understanding, what you're in,
Right. And if I make this mistake, and I want to keep you guys from making that same mistake, because live to fight another day.
Yeah, I mean, it's good advice, and that kind of, thinking about that, I have a really good example of leverage that I wanted to bring up. It's with gold, and I think that, kind of understanding when we talk about capital efficiencies, again, you hear that a lot, but how do you really understand it? What does that even mean? So the next slide kind of does a breakdown of gold. So basically what I did was I looked at micro gold futures contracts relative to GLD. So looking at micro gold. So say you wanted to buy micro gold. You think gold's going to go higher. So looking at micro gold, micro gold was trading at 3,400 per ounce when I looked at this, when I created this slide. The margin was about 1,500. And again, that micro gold is 10 troy ounces of gold. So in order to get the notional value of that contract, you multiply the troy ounces, that 10 troy ounces, times the price, which was 3,400 per ounce. That gives you a notional value of $34,000. So for the $1,500 initial margin for micro gold, you get access to $34,000 worth of gold exposure. Now that's great value. I mean, $1,500 to get $34,000. If we look at GLD, just a stock equivalent, if you want to call it, that tracks gold, at the price of 312, in order to get that same $34,000 exposure, that share equivalent is 108 shares. So having to put up and putting up $17,000, basically worth of that money in real dollars relative to just putting up the 1,500. So I think when you put it into real terms, it can really help. I also, the next slide, I think we could talk about it more once I get through that, but this does a margin looking at the NASDAQ compared to the Qs and NVIDIA. I chose the Qs, because the Qs are very common in relative to the NASDAQ futures. And then NVIDIA, a lot of the times when NVIDIA moves, the NASDAQ's moving just right with it. So thinking about the NASDAQ here. So the NASDAQ, the micro NASDAQ contract to be specific, trading at 24,900 bucks. The multiplier on that contract is 2. So the notional exposure for one micro NASDAQ is almost $50,000, 49,800 bucks. The CME margin when I created this just a few weeks back was $3,025. So for $3,000, you get access to almost $50,000 in NASDAQ exposure. Now, let's flip it. Let's look at the Qs. The Qs at $600. To get that same notional exposure, you would have to buy 83 contracts, and the Reg T margin on that typically being around 50%. You would need to put up almost just shy of $25,000 to get that same exposure in the Qs. So again, 3,000 versus 25,000 to get very similar exposure to the NASDAQ. And then if it really applies to NVIDIA. NVIDIA, in order to get that similar exposure, you would still have to put up near $25,000 and have to buy 285 shares of NVIDIA in order to get that exposure. So I think that if you really put pen to paper and you start writing down how this math actually works and what you can do, if you have a $10,000 trading account, this isn't really going to be good for you to look at on the equity side. But on the future side, putting up $3,000, it's about a third of your account, which may even then be a little bit overstretched. But if it's within your risk parameters and you still maybe want to look at another contract, maybe you want to look at micro gold too. Maybe you want to look at some other products. You have the ability to do so. And, as long as you have that risk management in place, you can have the ability to stay flexible with these markets.
Something that you just hit on where like pairs trading within markets, and it's so much easier to do with the lower margins. Like if you wanted to be long NASDAQ and short the Russell, you can do that in futures so much easier. And what your risks are. You've seen the two things move together, and you obviously work stops in both different assets, but it allows you the flexibility in futures to do it for much easier without locking up all your margin money.
100%, yeah. Just that flexibility, nobody wants to be tied up in one position, and at that point the market kind of dictates your entry and exit. You don't get to dictate it. So having that control as well is super beneficial. But the last couple of things we're going to go through, it's going to be talking about risk management and position sizing. And then I'm just going to pull up a couple charts that just kind of show at a very basic level what things can look like on a chart. But risk management is going to be super important. Jim, we've talked about this together so many times, but thinking about just overall risk management, my favorite quote I've heard, and I heard it from you, I believe, is plan your trade and trade your plan. So build a consistent approach when you're thinking about a trade. When you're entering a trade, you should go, hey, I want to buy this market. I've done my fundamentals. I've looked at the technicals. I'm going to buy this here. The next step isn't click buy. The next step is, where's my entry? Where is my total amount that I'm willing to risk? And where is my exit that I would like to exit, or start exiting my position? So I'd love for you to kind of dive into this and talk about your risk management profile there.
There's no question about it. If I'm trading the futures, and by the way, most people who are watching who know me know I trade options quite a bit as well, and I'll get to that in a second too. But every time, and particularly in the things that I trade that are highly liquid, the liquid markets, every contract that the CME has does not have equal liquidity. However, the ones that we mentioned before have tremendous liquidity. The reason I mentioned that is because putting in a stop loss, it is important that you're putting it into a liquid market that doesn't gap lower or gap higher in some huge vacuum. And that rarely happens in currency markets, equity markets, and the CME. So I base everything, how my trading style is off of a couple different moving averages, and what they're doing is like half of it. And if I put it in, exactly right. It's going to here, this is an action point, my target, and here is the level where I will risk no more. Now again, if you're as a trader, you know that if you're not willing to risk anything and going in, then chances are you won't make as much money either. Unfortunately, everything in life, greater risk equals greater rewards, but knowing it and controlling it is the key to it as well. And again, if you're a breakout trader, sometimes it's easy to just, okay, boom, I stopped myself into this market. I'm going to have my stop almost where I got in right away. And if it doesn't work, it doesn't work. I don't find that approach very appealing. It's never really worked for me in the past, but it's really, really important to set your risk parameters. Now, options, you can define it 100%. Now, using stops, sometimes there's a little bit of slippage. It's mostly defined, but it's not 100% defined. With options, if you buy a call spread or you buy a put spread or a butterfly or a condor, you can only lose what you paid for it, provided it's equal distances in the fly and the condor. So to me, exactly, that's why the beauty of it. I can go to sleep having call spreads on and something, going, okay, they're either going to work or they're not work, but either way, I don't have to look at them at 2 in the morning and say, oh no, I'm losing money, I got to figure something out. So I really think that risk management is a key to longevity and durability in this business. And there's so many people who come into it thinking, okay, I'm just going to make a ton of money. I hired a kid once, maybe 15 years ago, and I said, this is a level I want to buy, so I bought whatever at the price, and he goes like, well, if you think that's a really good price, why wouldn't you just buy 100 there? And I was like, that's why you are not going to stay in the business very long unless you change that attitude. You don't risk it all. Yes, I believe in this trade, but the question is, how much do you believe in it? It's not 100%. It's never 100%.
Yeah. If it was 100%, we'd be on a beach somewhere.
And I wouldn't be telling any of you guys anything, right?
Right. Yeah. So and you mentioned longevity. A lot of the times, when you think about a successful trader, the first thing that comes to mind is, well, how long have they been active?
Exactly.
Longevity is a common factor when you see these traders is, just minimizing, trying to hit singles and doubles, not looking for the grand slam, and minimizing the huge drawdown days. And, when we think about that, it comes into position sizing, which is kind of the next slide that we're going to go through. But this comes down to the individual. So when you think about yourself, when you think about your account balance, and you kind of start thinking about, hey, what products should I be trading and what size? All these different CME products, they have these different sizes. And, one of the reasons is we kind of have our ears to the ground and listening to traders saying, hey, I still want to trade NASDAQ futures, but it's a $500,000 notional value contract. I want to be able to trade this, but I don't want to have to know I have $500,000 on the line every night in notional exposure. So that's why we have these micro, these mini, the full size contracts, these spot quoted, these very small, different types of contracts you can trade. So Jim, when you're thinking about position sizing, like you mentioned, if you love a trade, why don't you buy 100? It kind of applies to position sizing. Like, well, why wouldn't you just, if you're going to buy, a couple micros, why wouldn't you just buy a mini here? How does that position sizing factor into your trading?
It goes into a really interesting psychology, I think, too, because people see so much in binary, like right or wrong, black and white, and traders don't see that. Like, there's different levels of conviction that you have on different levels of trade, particularly if you're a technical trader. Like, some of the technicals will line up enough to trigger a trade, but it wasn't 100% of all your technical indicators. So then perhaps you reduced size because you think the odds are slightly worse than one that met all the parameters. So, and by the way, it doesn't even list the spot quoted, which the spot quoted is so interesting, and I've been playing around with them, just they're so small that it's not really about making money or not making money. I'm just trying new different systems for short end day trading and using those contracts because they're trying. I think the spot quoted NASDAQ is like a $6,000 notional, right? So it's it's a very very small contract, and I use them for working on different trading platforms and styles. But yeah, the notion of reducing your risk, because as soon as emotion gets into your head, excessive emotion gets into your head, you will become a bad trader. I'll guarantee it. As soon as you see if you buy something, let's say you were trading the full size and it was like stretching your margin in your account, all of a sudden it starts to go in your way. The psychology is like, okay, take it off, take my, because I don't want to risk this much. But if you have a smaller one on, you let the trade play out because you can weather that storm. I think they're a brilliant addition to help retail traders learn about how to actively manage their money.
Yeah, I couldn't agree more. And what we're going to look at, for the last two slides here, it's just a visual representation is all it's meant to be. with risk management and with position sizing, looking at 2 separate contracts. So the first one we're going to look at is just going to be a mini size contract. So thinking about risk management. So what this is going to be is, hey, this is the E-mini S&P contract from back in the day. I want to risk $500 in order to make $1,000. Basically a 2-to-1 reward to risk. Like I want to make 1,000 to risk this 500. When you look at a chart, I always like to draw it out. And this is a short-term chart. This is a 5-minute chart. So you can see right off the bat, how much this 5-minute chart can move up and down. So understanding where, your entry is and where your exits are going to be. So that middle blue line, that was what I drew as just a basic entry point. So if you were looking at this market and you pulled up this chart and you said, I want to enter at that middle blue line, risking 500 to make 1,000, this is exactly what it would look like. So you can see essentially what it is it's just double the move to the upside. And, I think that it can be important to look at, these different charts when you're thinking about a position, because some people will just kind of throw numbers in their head. I'm going to risk, $200 on this trade. But what does that actually mean? What does that look like compared to how this chart is traded today? I mean, if you look at like this just choppy range up and down, basically that range of that day has been exactly what you're risking on this trade. And that upside, there's a lot of room to go on that upside, but you can see right before, towards that bottom left of the chart, you can see outsized moves like that, especially shorter term on like a 5-minute chart. Yeah. So I wanted to compare this, or go ahead, Jim.
So I was going to say too, by the way, just as a side note, that is a gorgeous chart to me. I love the fact that it busted out of the range a few bars back, and then it went back, tested the range again, and then shot it again. Based on one of my systems, I would be buying it right as it goes out. Now, the reason to put what Ryan says is that you don't just arbitrarily pick a level for the stop. You have to look at where, you don't have to, but you look at where resistance is. That bottom, that last blue bar, where all those lows came in before. And obviously, when we broke it just a few bars ago, it created some huge volatility. So that's an area of importance. So I would definitely put my stop just below that. I would love to be able to put it as like a stop close only, meaning they were going to close the bar below it, and that would indicate weakness too. But I love this chart. I want to go. I thought that was live, and I was going to click up my thing and buy this right there.
No live chart there. No, but yeah, I mean, I like what you said, but I do believe there is one more chart, the next slide, where it just kind of goes through. Yeah, here we go. So this is the micro S&P. And I wanted to change the duration. So this is the micro S&P 4-hour chart, because it is important. Sometimes if you were looking at like a 1-minute, a 5-minute chart, if you're staring at that all day, you could think that the market is going absolutely crazy. And it's going to go up and down, especially in today's world. But if you can kind of draw it out, look at a 4-hour, look at a daily, look at a weekly chart, it'll give you a different perspective. So this is the same idea, but buying micros. So that middle blue line is buying 3 micro contracts of this micro S&P with the same risk, risking $500 to the downside while trying to make 1,000 to the upside. And this is exactly how I laid it out. So that middle line again is buying 3, and then exiting 3 to the downside is that bottom line, and then to the top is that top line. So you can see they're a lot more narrow. And if you kind of just zoom out, I think it's important to highlight that if you can just zoom out from your charts a little bit sometimes and think about, because that gap looks pretty big to the upside on that 5-minute chart. Doesn't look as big when you look at a 4-hour chart. So it can really change your perspective. And I wanted to get kind of your thoughts on that, Jim, because I know sometimes I'm guilty of this. I'm stuck looking at price movements intraday, and then, I kind of need to take myself out of it and just go, oh, well, the market was only up X amount today or down a little bit today, but it felt like it was chaotic.
So by the way, most of my trades that I put, okay, I day trade. I day trade all the time. I day trade every day. I don't consider myself the world's greatest day trader. I probably play them to a drop for forever. And the reason I do it every day is just to stay plugged into the markets. Where I actually make money is, what I call swing trading. Well, not I call, well, people call swing trading, like a couple week time frame of something. And it used to always be just options that I would put on because my risk would be defined for those couple of weeks. But now with the reduced size contracts, I oftentimes use the reduced size contracts. So I like to go to look at a daily bar chart, like a 6-month daily, the 4-hour, 240-minute one, and then down to a 60-minute one. And I like for them all to agree, but I trade more on this bar chart, the 240-minute bar chart, because I think that it takes away some of the noise. When you look at the 5-10 minute chart too, it seems to be fluctuating quite a bit because the time frames are so much more condensed. And I think that noise and emotion can knock you out of it. You look at this chart, and again, where you drew that lowest bottom line, that's where the trend is broken. The trend since August has been higher lows, and it's still higher lows, and it looks like now we're about to go to the higher high. So yeah, I like everything you're saying.
Yeah, and that was a really good way to put it, just really understanding, that, you don't want to get caught up too much in these, 5-10 minute charts. It's important to understand, like you said, it can be important to point out, hey, the market moved, after this came out, after this report, after X, Y, Z, but then, zoom out a little bit, take a breath, take a beat, understand how this market's moving, over like a longer period of time can be very helpful for general direction.
And I'll say, add one other thing too, is the shorter duration charts you go, the much less any sort of fundamental analysis matters, because they trade more technical on the short, because they can, the stock market goes like this over time, it goes like this, but at any given day, you barely even notice that slope higher, and that's the last couple of years where all it does is slope higher, but we'll talk about that in another webinar.
Yeah, hey, I mean, talk about a transition from you there. It's almost like you're a professional at this.
Setting it up to the other one.
Yeah, I mean, we're running up right on time here. Again, if you have any questions, we have a few minutes, throw them in the chat and we're happy to answer them. But yeah, what we're going to be doing next week, we're doing fundamental and technical analysis. And, Jim, we've done this before. We've talked a lot about what you look at on the technical side, how you pair fundamentals and technicals. So basically, we're going to be talking about exactly how to blend the two together, because you'll have people out there, technicians of the world, that'll say, give me a chart, hide the name, I'll tell you if it's going up or down. You have your fundamental traders that say, I only trade based on, I do deep dives at earnings calls and I read reports of companies, or whatever it may be. We're going to talk about how to take both of those skills, blend them together, and use them in futures markets heading into next week. But as we kind of wrap up things today, I'm hoping everybody got a good general idea of, what are futures? How are they different from equities? Where do I start looking at these products? And that was kind of the goal of this whole thing. And Jim, your insights have been fantastic. I appreciate you hopping on. We're super pumped to continue this series. I think this was a great start. I think we laid the groundwork. I think jumping into the technicals and fundamentals is going to give people step 2 of really, understanding it and now analyzing it. So how do you go from step 1 to step 2 is kind of going to be where we go from there.
Love it.
But yeah, happy to, if there's any other questions that people want to throw in the chat, happy to answer them. But if we kind of are wrapping up here, very happy with, the turnout. Jim, thanks again for joining.
Pleasure. A couple of questions coming up here, folks.
Yeah.
So these are really on the mechanics that I'm trying to address here. So Francisco asks, can you also comment on volume? I understand that all orders have to go through CME versus in the stock market where they go through dark pools. Notes on that, Brian?
Yeah, so the CME, the central order book, all orders, will get, so basically what will happen is if you have in a brokerage account with Interactive Brokers, your order, you place it through Interactive Brokers. We have a whole back end system where it goes from order placed to order cleared. And there's a lot of different credit controls that are in there that are involved. It gets pretty technical, and we are going to kind of go through that at some point throughout the series of, what actually happens to your trade. But basically, your trade will go through, and then it'll go through all of our controls, which again fills in with part of the safety, the security with CME, but we have all these different controls within milliseconds. Your trade is going to go through, get routed through CME, and then it's going to show up on your screen saying that your contract is filled or rejected, and it'll tell you why, or you'll just get through on your trade. So orders will get sent right through CME and be cleared through us.
There's a question, another note from Francisco here. Some brokers offer less margin requirements than IBKR. How is this possible? Isn't the margin dictated by CME? I'll ask you that one first, Ryan.
Yeah, so
thoughts on that.
So CME does have margin requirements. All brokerages are different. Every product is going to be different. Typically, it's not, very different. But again, all brokers, they have the ability to have their own set margins. If you go on CME's website, they will have like a set. and you can see generally where margins are. But if you need to know the margin for a product, you have to go through your own brokerage. So I would go through on IB's website, through IB's products, Interactive Brokers, and make sure you understand what the margin is. But they will change just based on the structure of all these different companies.
And just to follow up on that, yeah, Interactive Brokers will raise or lower margin according to market conditions, and they have the right to do that, and they have done it in the past. And one market that I remember this happened to specifically was the silver market, and that might bring in Jim here, because I know you're interested in silver, but just explain what happens when a market goes loopy.
So, of course, when it gets loopy, there's just a tremendous amount of risk that the CME and any subsequent broker is taking on by allowing you to trade it. So it's really something to make the system stronger and more durable, so these places can stay in business and provide safety to the people who are trading the instrument. But again, it's not agreed upon and set in stone that the margin has to be on a certain thing, because all of a sudden at any one time, you saw what happened in the silver market recently. Silver was doing nothing as gold went through the roof, and then all of a sudden silver started shooting higher. When something starts shooting higher, it can shoot lower, it can shoot higher again, and the volatility is there. These places have to protect the trader and themselves, and that's why margin requirements can be adjusted.
And Alex asks, can you also sell with the same margin? Yeah, to go long or to go short. I mean, this is, I think Jim made the point at the very beginning of the, you're taking a view on a particular commodity future, and it costs you no more, no less to go long or to go short, and that's what makes a market.
Futures, it's a mirror image. And it's frictionless selling, unlike in equities.
Yep. Let's see. I think okay. Theodore asks, what are the best educational resources to teach oneself excellent futures trading techniques? So I have two responses to this. We work very closely here at Interactive Brokers with the CME Group's educational department.
Yeah.
To me, they have got the best. Certainly video content to help people understand, even from a beginner level, but to a more sophisticated level, understanding margin. It's a knock 'em dead educational resource. Massive amount of videos being built in multiple different language. We have borrowed many of those videos and put them on the Traders Academy and built our own to support our own products and technology. And I would also go out and look for, not even necessarily institutional level research, but look for people who comment frequently on markets. Jim, do you do something like that? Do you put out newsletters and so on?
Oh, absolutely. We have the Futures Edge is a podcast that deals with a lot of the topics we're talking about too. The Traders Edge, forget about that one. The unfilteredinvestor.com is our weekly newsletter where we go over futures. It's me, Bob Iacchino, and Mike Arnold, who's our chief technical analyst, and we talk about trading futures quite a bit, and we're going to even get more into that as well. But yeah, I love being involved with, by the way, and being involved with the retail trader, I don't just do it out of the goodness of my heart. I tend to think of things that I wouldn't have otherwise when I'm preparing to talk to the retail traders. So I do it for selfish reasons as well, but I love doing it.
Excellent. And I guess the final point from Matt here is about the CME Group's balance sheet. Is there any kind of default risk? Is there anything you want to say about the CME Group? I know you said it's been around for probably more than 200 years, Ryan.
Yeah, I mean, the CME Group, I mean, when you think about us, it's the evolutions that we've taken that I think are kind of the most important. And the reason that the evolutions happen is because we simply listen to customers. We talk to people like Interactive Brokers, like all our different broker partners, and we say, hey, what are your clients' needs? Do they want, different types of products? Do they want crypto futures products? Do they want smaller sized products? What do you guys need? What do your traders want? What are you hearing on the front lines? Because that's what our brokers really are, is the people on the front lines that are working with the individual traders. So I think that is kind of where we've gone, and that's our future. Is we have all these great products. We've shown that we have these strong credit controls. We've shown that we've continued to be strong. Now, as we've seen a lot of volatile times lately, people can trust our markets to come and hedge their risk or speculate on a position long or short. And I think we're going to just continue to evolve. We've expanded, our futures options for our crypto markets just this week. We've expanded, our crypto suite as that has grown over the last couple of years, now offering bunch of different products. So I think that the CME's evolution is just going to keep going dependent on what the market demands. And we have our ears to the ground, and that's basically where we're going to go, is we're going to listen to what people want, and we're going to do our best to help facilitate that in a safe and effective way.
I just add to that. I've got one more question for Jim before we go, but I just want to add to that. Jim, do you remember? I think St. Patrick's Day, around then, March 2009, low of the S&P after the Great Financial Crisis. What was it roughly?
That sounds about right. Yeah.
Yeah, but what was the value of the S&P?
Oh gosh, I don't remember. I remember. I don't remember exactly.
It's the number of the beast, Jim.
What is it?
666.67.
Oh, 666. Of course it was 666. I know that, Andrew. I'm sorry. Let's rewind it. I know that it's 666.
My point is that, Jim, the point is that the index was 666 back then, and today it's like 6,800. So it's up 10x. That's why these the notional value, you're multiplying, you're using the contract multiplier by the index level. The margins get higher, isn't it?
Yeah, of course. And by the way, and the names get ridiculous. To call it an E-mini contract, it's not mini at all. It might have been mini when they launched it. Now it's a big contract, but that's put that in there too. Yeah.
Now, something I wanted to pick up on here is Leonard's asked the question. It's a better, and this I want you to go into things like first notice, last notice. He has to better understand the worst case scenario. If one holds a contract to expiration, which I'm going to suggest you don't do, the capital commitment is the notional value minus the margin. Just talk a little bit about the role, the continuous contract. You shouldn't be holding something to expiration, Jim.
No, there's no question about it. You shouldn't be holding things to expiration, and it gets really, really dicey around then too. So that's one thing. I'm so glad you brought it up, Andrew, because I would love to hammer that point home. Is roll your contracts when you can, before it's absolutely essential. Because you never want to be in a market where everyone knows exactly the trade you have to make. And not that any of us are going to have big enough positions in these markets to move it that much, but always roll it at least. I always like to roll it at least a week or two before it goes. Now with options, sometimes it's harder because sometimes the value of an option you sell, it starts to decline more towards going into it. So it's a little bit, I like to get it a little closer to get all the juice out of the orange. But when you just have futures contracts, roll it as soon as it becomes a second month contract, roll it to the other, and don't get caught up in what can happen on delivery dates and things like that.
Yeah, you're not looking to take delivery of treasuries, notes, bonds, or
oil.
Or oil.
Yes.
No.
Maybe our gold. So do we still physical settlement gold in the CME, Ryan?
Yeah, I mean, people can take physical delivery. It's you got to have the stomach for it, you got to have the dough for it, but it's still a possibility.
Yeah, so I've never done that, obviously. Yeah.
I'd imagine you probably need some insurance too.
I would guess.
Yeah. Oh, yeah. It's a process, that's for sure.
Brilliant. Excellent presentation. Somebody asked the question, where can I sign up for the rest of the series? I did put that link into the chat panel. So it's on the Interactive Brokers website under Education and Campus. And look out for the webinars section, and you can register. And I think we're back on, you mentioned the 29th earlier on. Let's just double check that. The Analyst Toolkit, is that the one?
Yeah, that sounds right. Fundamental Technical Analysis.
October the 29th at noon Eastern. So that's probably around 11 o'clock in Chicago, isn't it?
Yep, that's right, yeah.
Perfect.
Brilliant. Jim Urio and Ryan Gorman, thank you both very much for joining me today.
Thank you, guys.
Thank you so much. See you guys next time.
All right, and thanks to the audience, and we'll see you on the 29th, hopefully. Bye for now.